Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about 5 Canadian stocks that are at their 52 weeks low, and I will discuss whether these stocks represent a good buying opportunity or not. Being close to 52 weeks low doesn't mean you should buy these stocks, but it means this is probably a good time to start looking at the fundamentals of each business and evaluate these companies. I want to go through financials of some of these companies and share my perspective on these stocks with you. We have a lot to cover in this video, so let's jump right into this. The first stock, which is at its 52 weeks low, is TD Bank. TD share price is around 77 Canadian dollar at the time of recording this video. The stock had a 52 weeks high of $103. So as you can see, this stock is down almost 25% in the past few months, which is a lot. Actually, if you compare the recent performance of TD in the last month to its peers in Canadian market, you will see that TD dropped significantly more than other Canadian banks during this banking system fiasco in US and Europe. TD share price dropped by 14%, while, for example, Royal Bank is down only 8% in the last month. Of course, the reason for this overreaction on TD is their exposure to US banking system and their offer to acquire First Horizon Bank, which definitely took a hit during this fiasco as well. However, I don't think these issues in US regional banks will have any major impact on TD. Historically, TD stock barely drops more than 20%, and when it happened in the past, the stock recovered in the next couple of months and hit a new all-time high. I personally own 120 shares of TD in my TFSA account and recently added to my position during this dip. In terms of the valuations, TD currently trades at 1.4 times of its book value, which historically is a good time to buy this stock. The 5-year average price to book of TD is 1.68 and the current price to book is 1.41. So it looks good here. The stock is paying a nice dividend with a starting yield of 4.9%, and if you look at the history, they consistently increase this dividend year after year by around 8 to 10% on average in the recent years. Overall, I think TD is definitely an interesting stock to consider here for your portfolios. The second stock, which is close to its 52 weeks low, is Pembina Pipeline. This stock had a 52 weeks high of 53 Canadian dollar, which means the shares of Pembina is currently down 22% from its 52 weeks high. Pembina is a Canadian energy transportation and midstream service provider. Their business has 3 divisions: pipelines division, which is the main business, facilities division, and a small subdivision that they call it marketing and new ventures. They own 18,000 kilometer pipelines that transport oil and natural gas primarily in Western Canada, British Columbia and Alberta, as you can see in this graph. They also own gas processing facilities and oil and natural gas liquids logistics in various parts of Alberta, British Columbia, and even in the northern part of United States. OG subscribers of the channel who follow me for a while probably remember me owning this stock. This was my main play during pandemic together with Suncor Energy. I bought Pembina shares in January 2021 at around $32 per share and then sold it almost a year later for $50 per share for a very nice profit. The shares of Pembina dropped quite a lot in the past couple of months as the price of natural gas went through its cycle, and now the stock trades almost close to $41 again, close to its 52 weeks low. They pay a very attractive dividend with a starting yield of over 6%. I think Pembina has one of the best management teams in energy sector. I was really impressed with their capital allocation in the past. They had a relatively consistent growth in their EPS and cash flow due to the nature of their business. Their financial metrics are less volatile compared to other stocks in energy sector, as they usually operate based on contracts for transmission of oil and gas through pipelines, and their revenue depends less on the actual price of oil and natural gas. It is still cyclical, but at least less cyclical compared to pure oil companies. In terms of the valuation, the stock is currently trades at a price to cash flow of 7.9, which is historically a good starting point in buying this stock. But I will wait for something close to 7 times of price to cash flow to start to consider this stock. Overall, I really like to own a business in energy sector as my portfolio lacks any energy exposure at the moment. So if the share price of Pembina drops below $40, I will start to look into this stock again in detail, and we'll look at the recent earnings report and we'll try to see if things are still moving into the right direction after 1 year for this company. For me personally, it's not a buy here, but I will closely watch this stock for now. The third stock, which is close to its 52 weeks low, is Brookfield Corporation. As you can see, 52 weeks high of Brookfield Corporation was 59 Canadian dollar, while it is currently trades close to 41 Canadian dollar, which means the shares of Brookfield Corporation are down almost 30% now, which in my opinion represent a very attractive opportunity to look into this stock. Brookfield has many different types of businesses ranging from real estate to asset management, renewable energy, insurance, infrastructure, and other businesses. They find undervalued assets and businesses around the world and invest in those to realize their intrinsic value and return the profits to shareholders. I talk about this stock a lot on this channel, so I don't want to repeat the previous information again. You can watch my recent video on Brookfield in which I went deep into Brookfield business model and explained why this is a great stock to buy. I own 250 shares of Brookfield in my TFSA account and recently bought more shares to take advantage of this dip. If you don't own Brookfield, this is a good time to at least look into this stock and do some research about them. The next stock, which is close to its 52 weeks low, is Nutrien. The stock had a 52 weeks high of 147 Canadian dollar, and it is now trades close to its 52 weeks low at $98 per share. Nutrien is the largest potash producer in the world, and it is an agricultural service business based in Saskatoon, Saskatchewan. I'm preparing a detailed stock analysis video on Nutrien, so don't want to go into much details here. Anyway, just looking at some simple metrics like price to sales and price to cash flow show that this company currently trades at a relatively attractive valuation compared to its historical averages. The stock currently pays a dividend with a starting yield of 2.8%, and they have a history of paying out dividends, but their record is not the most consistent record in the world. Their business is a little bit cyclical, as some of their financial metrics depends heavily on the price of potash and the demand for potash, and therefore their profitability and cash flows may change from time to time. Anyway, I think this can be another attractive option at these prices. I personally will wait a little bit more before starting a position in Nutrien, but definitely will watch this company closely at these levels. The last stock in my list, which is close to its 52 weeks low, is Northland Power. This is a company that develops, builds, and operates green power projects in different countries around the world. The company produces electricity from wind, solar, hydropower, and biomass. But their main focus is on offshore and onshore wind turbines. They pay a dividend with a starting yield of 3.6%. The 52 weeks high of Northland Power was 47 Canadian dollar, and it is currently trades close to its 52 weeks low at $33 per share, which means it is down around 30%. I analyzed this stock in detail in the past and concluded that Northland Power was overvalued and its fair value was close to 26 Canadian dollar. So I'm not going to go over the details of the current valuation of Northland Power, but anyway, it is now trades at a more attractive valuation, and I am watching this stock closely. I don't buy this stock here yet, but if it drops below $30 per share, then I will start to look more closely into their business and go over the financial reports. Overall, this is another interesting stock to watch at its 52 weeks low. There you are, guys. I hope you enjoyed the video and my coverage of 5 Canadian stocks at their 52 weeks low prices. If you enjoyed the video, make sure to subscribe to see similar videos. Remember that this video is not a financial advice for you to buy, hold, or sell these stocks. This was just my personal opinion, and you should always do your own research before making any financial decision. Thank you for watching this video, and I see you guys in the next video. Farewell.